Good morning, ladies and gentlemen. A warm welcome to all of you who have joined us for our program, Company Secretaries Pivots of the Board. A word about the organizers. Excellence Enablers, a corporate governance and board advisory consultancy firm, was set up over a decade ago. The continuing endeavor has been to grapple with the issues that impact the interest of the stakeholders while at the same time demystifying corporate governance. Working with the founder, Mr. Damodaran, on this endeavor are a number of highly experienced and renowned consultants and advisors, MBAs, company secretaries, and lawyers who offer experience based consultancy. Over the years, Excellence Enablers has assisted and continues to assist several companies and groups with their services, such as finding directors for their boards, board evaluation exercises, training of directors, and improving board processes and performance, to name a few. For the past 13 years, Excellence Enablers has been organizing several by-invitation programs to promote conversation among various stakeholders of corporate governance. True to the company's motto, we believe in adding value and not ticking boxes. Today's program is yet another endeavor in the same direction. May I request Mr. Damodaran, our chairperson, to welcome our guests and make his opening remarks. Our first session is on minimum information or RPTs. Let me introduce our panelists. Ms. Neerja Sharma is the Company Secretary and Chief Compliance Officer of InterGlobe Indigo. In her previous jobs, she has also been a member of Ethics Committee, member of the Steering Committee for Driving Sustainability, and Chair of Committee for POSH. Mr. Narayan Shankar was still very recently the Company Secretary of Mahindra and Mahindra. He has been a member of the working group to review provisions relating to trading plan under the SEBI PIT regulation 2015. He is a non-executive director on some group companies within the Mahindra group. Mr. Sanjeev Grover is the Company Secretary Maruti Suzuki Limited. He has been and continues to be an active member of Secretarial Standard Board of ICSI. The moderator for this session is Mr. Satwinder Singh. He is the founder and managing partner of Aekom Legal. He has been nominated by the Government of India as a member of Appellant Authority constituted under the Chartered Accountants Act 1949, Company Secretaries Act 1980, and Costs and Work Accountant Act 1959. He has been chairman of Expert Group of Secretarial Standards of Board of North India Region Council of ICSI and is a member of various committees of various chambers of commerce. He is the author of several books. May I now request Mr. Damodaran to welcome our speakers.
Good morning, ladies and gentlemen. Thank you for taking time out and joining us today at what I believe promises to be an interesting gathering of persons who are tasked to ensure that companies don't go off the rails, run on the right tracks, and deliver value to all stakeholders. It's a privilege to be with you here today. Let me tell you a few things about the company which might interest you. When we set out on this journey 13 years ago, we were told by a lot of persons that we were going to waste our time trying to push the cause of corporate governance. There were a whole lot of disbelievers, and those that were positive you could count on your fingertips 13 years ago. As I speak to you today, I believe that over the years we have added a lot of people to the movement. I choose to call it a movement to promote higher standards of corporate governance. I have been a student of corporate governance for close to 25 years now, perhaps even earlier, but consciously over the last 25 years. I have studied governance in India and outside, and therefore I thought that it's useful to do what one can do to see that companies do the right things. I must also share with you our definition, Excellence Enablers' definition of corporate governance. It's very simple, because one of our tasks is to demystify corporate governance. A lot of people think I was at a conference day before yesterday and somebody asked me, so it's very complicated. It's like the elephant, somebody's touching the trunk, somebody's touching the tail, and then saying that, you know, I think I've got it all. No, you haven't. You need to get the whole elephant. But it's not complicated at all. And our explanation of corporate governance is doing the right things at the right time, in the right manner, and for the right reasons. That's it. It's not more complicated than that. So what we have done, and the movie that was here demonstrated, it's gone away, but what we've done is to engage with all manner of stakeholders. You name it, we've engaged with them. Right from the chairpersons, and we have properties of ours. We have a property called the Chairpersons Conclave, which is our property. We have got a lot of chairpersons in conversation. We have got a property for CEOs called CEOs in Conversation. We have several other programs that we do, not just training programs, but roundtables by invitation. We do, of course, training programs, and then our big event, which we do annually in Mumbai in November, which is a 2-day program on governance. That was one occasion when we were told, how can you sustain a 2-day program on governance? God is kind. We will be doing our 10th program this year. Even COVID hasn't set us back. And it's a very well-attended program. Just to give you 2 snippets of information. One, and I take great pride in saying this, I say that several other people do programs. The advantage with our program is that in our audience, you can find at least 40 to 45 people whom I can call up on stage and ask them to be a part of the panel without any preparation. That's the quality of the audience that come to our summits. Right? So there's no shortage of programs, there is no shortage of interventions in what we do. But we've always believed that people like you, who actually ensure that the board does its job well, who ensure that the directors are enabled, empowered, encouraged to contribute to discussions. You don't seem to be getting the kind of attention except what your institute provides for you. But we have engaged, as many of you know, with company secretaries over the years, not in gatherings like this, but in smaller groups, individually, etc. And we thought it's a good time today when there is a lot of regulatory hyperactivity, moving from activism to adventurism, that company secretaries get together, address the issues which are center stage, which are topical, and see how, in a consultative manner, you can resolve some of the pain points that are presently being experienced by you. So we've structured this in 2 sessions. The first, of course, is up there, and the panel in front of you will be addressing that. The second is a larger broad spectrum question, which is, how do company secretaries ensure that boards get into a decision-making mode and actually take decisions? How do you facilitate that? How do you handhold members of the board who might be less informed, both about the roles as well as the domain, to contribute to decision making in the boardroom. That is the larger question that we will address in the second session. Now, this is a subject that all of you know. I have been openly critical of this, and I'm personally delighted that the new SEBI chairman has pushed back implementation by 3 months.
Yes.
As I was telling some of you before we came here, I personally hoped that it would be 6 months. It didn't happen because in 3 months there's only so much that you can do. Perhaps another extension cannot be ruled out because you need to see that some of the relatively less relevant and more problematic provisions in that particular circular are taken out and buried so deep, as somebody said, Aurangzeb said. It's not fashionable to talk about Aurangzeb, but when he heard about music, he said, bury it so deep that it does not surface again. So I hope some of those provisions will be buried that deep and they will not surface again. Somebody helpfully counted in one program that I was doing that there are 88 boxes to be ticked in that circular.
Yes.
And if you are a promoter company, maybe if you're not a promoter company, a few lesser boxes, but not too many less. Now, is that the way that you conduct business? You remember the old Tata ad, which says we do this, that, and the other. We also make steel. The old Tata Steel ad. It's come to that now for companies. We also do business. After you've been through all of what SEBI requires you to do, what NEFRA, the latest kid on the block, wants you to do. The questionnaires for the Audit Committee members saying that these are the questions you need to ask your auditors. And if all those questions are asked and answered, Audit Committee meetings will last all of 3 days every time. So that's the situation in which you are today. And we thought that a discussion of this kind is not intended to be one-way conversation. I'm sure a lot of you will have questions to ask of the lady and gentleman here. So without further ado, I will hand it over to my dear friend, Mr. Satwinder Singh, who has been helpful in putting this program together by way of getting people to participate. I released his book in 2014 along with Justice Sikri, the first book that he wrote on Companies Act. And since then he's been repaying that favor, if I may call it that, by helping me out with all these initiatives. Right? Thank you, Satwinder, for that. Right? All the other panelists, of course, are very, very experienced people. So all yours, Satwinder. Take the ball and run.
Thank you, sir, for indeed it's an honor, it's a privilege that I always feel that okay, your blessings are always on me, and wherever I can be of any help, definitely I can put it. I think, but it's a great opportunity when we were discussing about the minimum information on RPTs, and when we were discussing on that panel, I think the Neerja, Narayan, Shankar, I have a great privilege of working with him when I was chairman Secretary Standard Board for almost 4 years, and Sanjeev also was part of the Secretary Standard Board, and in fact SEBI asked us in 2018-19 to start working on the charter of that audit committee, and Narayan Shankar was instrumental in bringing the charter on that. And I was so happy that okay, the charter which we had prepared in the master circular which had come, I think most of the things were coming on the charter. So if I historically see that we had a clause 49 of the listing agreement, it moved to regulation 23 of the LODR, and then various circulars, and then we had in November 24 that master circular on the on particularly on the related party transactions, where part of this was also put to us as regard what we had put it on the charter also this way. But before you see, you gave me the opportunity rather to go in details and putting questions which I am bound to ask to the panelists. And I was asked by my team members, sir, Mr. Damodaran is from the regulator. Would you be critical in front of him and all that? I think you have relieved me by saying that you are. This is
Yes.
so. Thanks for giving me the comfort and all. I think Neerja is also relieved, and there's and so we have before us the industry standard norms, which in a short form we normally talk about the ISNs, and this is a product of the industry standard forum, which was constituted with the representatives of CII, FICCI, and ASSOCHAM under the aegis of stock exchanges and the guidance from SEBI. Am I right, Narayan? And probably Narayan is a part of the the forum. So I am equally targeting Narayan for certain questions which probably he has to bear with us on this. But yes, the emphasis on the greater transparency, accountability, minority protection is the one which the regulator is always having a concern on this. But on the whole, when I was reading it, particularly I am on the board of certain listed companies also, as on the audit committee, on the others, the subsidiary of those listed company, and some other companies, which really gave me the shiver. That one, that is it that the company secretary is going to be burdened or loaded with so much responsibility, and are we looking at it as the regulatory aspirations or the operating reality? I would say that the idealism versus pragmatism, which we really need to weigh and see how the gap, we have to bridge that gap for this. So you rightly pointed out that there are 88 columns, but it is not a tick the box columns. Particularly, it's not only the procedure, but the kind of substance, the kind of information they are needing. And all that is required to be placed as part of that agenda. I don't know how that agenda on that related party transaction is going to be, how much voluminous and how much time it will take. These are the questions. But I'll start with Neerja on this thing, because I feel the first honor is to the lady on the panelists to talk about that. As regard that question which we are talking about, the master circular, it is superseded by these now the industry standard norms by way of the SEBI circular. Now, what do you see that as regard the, what is the objective of bringing? We had November 24 master circular, now we are coming out it is. What is the need? What was the objective that okay, we have to bring it? And is there any difference which you feel that okay, as regard the master circular and now the industry standard norms? And do you see that, I'm not sure about it, that I could find any global standards on the related party transactions which would have been on a comparable jurisdiction? What is your thought on that, Neerja? I think I'll start with you on this thing.
So thank you, Satwinder ji. I'm going to start by saying that the stated objective, as I see the circular, the stated objective of the industry standards that were issued recently is to standardize the format for minimum information to be provided to the audit committee or the shareholders for review and approval of RPTs. one can assume that the objective is possibly benign. The objective is to seek greater transparency, accountability, to ensure that there is, possibly a prevention of conflict of interest by setting guidelines to identify and manage conflicts of interest that may arise from related party transactions, and thereby protecting the interests of the minority shareholders. The master circular, of November had provided a very broad, provided a broad framework, while the new standards are more prescriptive and detailed for various scenarios and types of transactions. The new norms have introduced stricter thresholds for disclosure, thereby possibly enhancing the rigor of compliance. The role and the expectations from the independent directors, the audit committee, the KMPs has also become a lot sharper. The introduction of the standardized format is obviously expected to bring in uniformity of practice, not leaving room for individual interpretations. And yet, having said that, I think, and I speak for myself, that the standards have possibly been drafted from a place of lack of trust. We already have a very robust regulatory framework around related party transactions. We've all been party to strengthening our organization's internal systems and processes to make sure that when we put up something for approval, we've done enough rigor, there's been enough rigor internally, for the transactions that are being put up. So one wonders if there was really a need to complicate our lives thus. And I take heart from the circular of March 2021, and I quote from it. One of the clauses says, the Industry Standards Forum shall take into consideration the feedback received for simplification of the industry standards and release the same in a time-bound manner to meet the revised guidelines. So there is hope.
No, I think thank you, Neerja, for putting the perspective as regard the objectives which you talked about, various things, but you are equally critical about the information which is required. I think March 21 circular is the outcome of that February 14 circular. I am just making it is because I have now the questions to Narayan Shankar, and this circular is only talking about that the extension of the time, right, to July 1st from what it was supposed to be April, so 3-month extension. Now, Narayan, few questions to you. I think we haven't had the time because he came late, but I have prepared some questions for you, right? Having been part of the ISF, right? What do you think, why there was a need to complicate the RPT regime again, right? Was not that existing regulations were enough? That's one question which I thought that I can have it. Then if you see the ISNs, industry standard norms, you have to have a bifurcation. One, the material transactions, right, comprehensive. Then is the other where there is a threshold limits, again the comprehensive disclosures. Then is the limited disclosure, then is the minimum disclosures, right? And even on that 88 columns, the kind of information that is being asked for. So what was the logic of bifurcating those RPTs into those 3 different segments to that part? And then I will come to this March 21st circular with February 14. The third question, which if I think you'll take it up for this thing is, if you look at this February 14, which I was reading it, right? Now this is based on the industry standard forums recommendations. But sir, the point which I'm just going to make it is the if I see the February 13 circular, now February 13 circular of SEBI talks about Securities and Exchange Board of India procedure for making amendment and renewing regulations. And it's a day before the February 14 circular came. It talk about the public comments and the public consultation, and then it is given the regulation in case of exigencies, that these public comments can be skipped if there is any exigency. That's a proviso to this. I'm saying February 13, February 14, a new circular is coming, giving the minimum disclosure norms, and then there is an extension. And what I think Neerja has rightly pointed out, now there is a hope that inside that circular you're talking about, which had formulated, shall take into consideration the feedback received or simplifications. Now, is there any need of that where we should put it to the public comments? Because to the best of my understanding, which I have studied on this thing, those industry standard norms have not been put it to the public comments. Now, on these three questions, I think I'll try to further set the tone for the discussions which we need to have.
Sure, thank you. First of all, just wanted to make a mention. While I am a member of the, I was a member of the ISF, views expressed by me today need not be that of the ISF, correct? It's completely separate. It's my personal views. So first, it's just a 1 hour slot, so let me be to the point quickly. What were the reasons which the regulator had to come out with this itself? Like Satwinder said, was it really required? You had the November 24 circular, you had the Companies Act regime, you got the LODR, you got related party transactions being defined differently in 21ZC. 21ZB calls about related party. What were the issues? One, besides the case laws which I am going to touch upon, independent directors themselves have gone to the regulators, many of them, of saying inadequate information we are getting. Second point which was mentioned is the information coming from company to company is differing. The template is not the same. And many a time the question which is being asked by the independent directors to the board and to the management, that can we have alternative bids or can we have additional? And many a time the answer is that's really not required. That's not mandated, quote unquote, by law. So hence, a feeling was that if there were certain things which they have gone through in their experiences, if there is a mandate, specifically as disclosure regime, mandate means we are not changing. Mind you, this is just a disclosure regime which has come out. It's neither changing the definition of related party, nor changing the related party transaction, nor anything, business as usual. It's only trying to say there was a circular earlier giving you list of things which audit committee needs to do. Today that is just being superseded of saying what are the other things which we can do. And the last one more point which came up, and Satwinder, this we had discussed even as part of the SSB. What is, if many a times independent directors have said the opinion of the audit committee going to the board not recorded in the minutes. So there is a loophole that there are only certain opinion, if it is not approving a related party, which of those will have to be disclosed by the board and which of them have to be disclosed by the board in the board report. We've had a major discussion, there is a guidance paper also of the institute on that. So coming out of that, there were many requests and all of them were tabulated as to how, and I'm saying many of them were small size, medium sized companies of independent directors who had come. And to give some cases which I had just broadly say, a company complaining that there is a sole distributor of their products. That sole distributor, the independent directors, how can I put it, having a hunch that it belongs to the promoter group entity, but the manner in which it is done, the promoter group is only having just mere 2 to 3%. When the independent directors are raising this point with the CEO, CFO, there is a hunch, but the market is talking about it, but neither the CEO, CFO nor the auditor is saying nothing required, because quote unquote it doesn't come within the purview of related party, although promoter group may be interested What do you do with that? Correct? Number one. Number two, a company in losses giving loans as ICDs to subsidiaries, and that too giving loan to subsidiaries whose creditworthiness has just come a notch below just last year. Giving loans to a subsidiary where the question of repayment itself is going to be questioned, okay? And over and above that, no information coming on the average rate of interest. What is it going to be done? Third point. Again, the third point was an airline company having a flight kitchen facility without alternate bids being called. And again, allegation that it is pertaining to the promoter group, we know for sure. And again, this we are being asked to do without alternate bids coming, without it coming to the audit committee. And when the question was raised, why? Because it is again not coming as quote unquote within the related party. Okay. Another company's example which had come is taken nearly crores of short-term loans and facilitating, or I'll not use the word facilitating, being given to related parties, but not as loans. Again, beautiful way of doing it. I'm saying it is in the garb of book debts, but actually it's a loan. And hence the key question which was coming up is, if the question is being given that the book debts are increasing, the independent directors are saying, without, how do I put it, without an alternate sales, and your underlying transactions are not increasing. That means the sales or purchase is not going up, but book debts are going up. These are all indications of saying if it is a loan, should have come to the audit committee. It's a related party. But on the other hand, the management says, sorry, it's not loan, it's trade receivable. And hence, I'll not be getting it to the audit committee. Hence, again, how do you get even advances which are paid as part of a particular transaction? How do you get that also in the disclosure regime? That was next point. And creditworthiness, I have already made a mention. Payment terms, correct? Again, payment terms being given to a particular customer who's a related party, which is much more liberal than the other people. Okay, how do you do it right now? At the end of the day, last but not the least, which is a live case today, which had come earlier, hedging of forex outside the balance sheet. Hedging of forex without underlying purchase or sale transaction. It is clear speculative transaction, correct? So, to address this, lot of times NFRA, like Mr. Damodaran mentioned, NFRA was also key contributor to this. They were questioning auditors because when they were going through the documents of 2 to 3 audit firms, it is in public domain that they didn't have basic documents. That means the company didn't have basic documents of what is the proof they are going to do on basis of arm's length basis. So, basis of all this, like Neerja said, we said that there was a requirement to say that November 24 will have to be reviewed. There is additional disclosure which would be required to be made so that audit committee, the independent directors get much better hang of what is happening, and their comments on many of the items. If you see this new disclosure standard, audit committee has to specifically make their comments. The second, to answer to the second point of Satwinder, what was the logic behind giving 3 buckets: comprehensive, limited disclosures, and the third was minimal disclosures?
Yeah.
So, we said that if it is material disclosures, that is crossing your threshold or 1000 crore, comprehensive disclosures by default, you have to give it. Second, we said if a transaction is with a promoter group, or the third point coming out of that case, even a related party where the promoter has got a 2% stake. We are not changing the definition of related party, but trying to say if a promoter group has got 2% stake in that company, have comprehensive disclosures. Third, if you are with a promoter group and the threshold of 34(1)(c) of LODR, which is 2% of your net worth, 2% of your turnover, or 5% of your profits of the last 3 years, if it is breaches, go for comprehensive disclosure. We said if it is less than that, we will not ask companies to give comprehensive, we will only give limited disclosures. But if it is a balance sheet item, That means if you're going to give investment, loans, guarantees, borrowing, financial transaction, hitting your balance sheet, we will require comprehensive. And if it is mere business as usual, which is your purchase or sale of goods or service, it will be limited disclosures. And below particular threshold, we say it's minimalistic disclosures, what you say. So there was a logic behind it to say, if the promoter group, so how did it change? So first was, should we ask companies to give all these disclosures for all the transaction? That was one. The other way of addressing it, if the promoter group is involved, please give additional disclosures. If it is a balance sheet item, even if it is below your 34(1)(c) limits, please give comprehensive disclosures. So I thought that was the logic behind which it is given. And to the third point of asking why industry standard forum is not subject to what I can say public, that's not the way it was viewed, but there's always, we are all evolving, we can always change. Like for example, when you came with market rumor, correct? Market rumor as a regulation will come for public debate, definitely. But then the standards for disclosures, which was made by industry bodies themselves, that need not go for public comments, correct? But today, coming from the comments which we are getting from CFOs everywhere, we said that even if it is one comment or one submission which is being made to SEBI is, even if it is all three industry bodies, yet can it still be available for comments? Answer is yes, of course. And yet this is one more submission which is being made to SEBI, that even in future, all disclosure standards being made by industry forum, can that also be available for public comment? Because they say there may be limited people who are representing these forums, okay? And that's not collective wisdom of all. Why don't you again throw it open? It appears, the initial view was it appears duplication because it's the same industry forum which is making, but yet even that is probably being accepted. Today, like Mr. Damodaran said, we are there is a 3-month extension given. Even today evening, we are having a meeting with all the CFOs of major companies where we are going to hear them out, what are the issues they are facing coming out of it, and we'll try. And of course, a larger question, not to you, Satwinder, but we will raise it to Mr. Damodaran. At the end, if you have a bad conduct, correct?
That's what I thought that
you should ask, if there is a bad corporate conduct, is legislation the only way? Probably he'll be able to throw light better.
I think I'll leave this thing at the summing up. I am just making it is because I think you have very well pointed out the logic for, you see, bringing this norms. But why, you see, when you make it as a law, right, you have to see the law as it is, what is appearing in this thing. Now, I'll put it to this thing, why so much onus on the audit committee? And that audit committee, because related party transactions have to be approved by the independent directors independently to that part. That means the onus on the independent directors. I'm just making it is. I'll give you certain justification for this. One, that the certificate which is to be given by CEO, CFO, that the transaction is, this is the company's KMPs, and the company secretaries are KMPs. That the RPT purpose, and that a certificate which I would say the company secretary is giving, is not prejudice to the interest of the public shareholder. It is going to be carried on the same terms and conditions would be applicable. That's a one onus which is coming to the company secretaries. I would say CEO, CFO and all that. I'm extending it because ultimately they'll say, you give the certificate, you are a compliance officer. But larger aspect on the independent directors. You ask for that copy of valuation or other external party report, you have to see it. Then what is being coming is, if any such report has been considered, it shall also be stated whether the audit committee has reviewed the basis for the valuation contained in the report and found it to be satisfactory based on their independent evaluation. Now, independent evaluation by the independent directors on that valuation, that's a one part. then you are coming to is that the related party, you have to make that statement on the assessment of the credit worthiness of the related party by the independent directors, right? And then is on the return of equity. If you put it that on the return of equity, return on past investments in the related party when you are making that investment, in case of diminishing value of investments, negative returns over the last 3 years, audit committee to provide justification for the, so there's so much onus which is coming on the audit committee and particularly on that independent directors. Last but not the least, there are so many things. I am more concerned about it is statement of assessment by the audit committee that the relevant disclosures for decision making were placed before them and they have determined, I think determination is by the independent directors, that the promoters will not benefit from the related RPT at the expense of the publisher. I think it's a too much onus. If I would say as an independent director, I was saying that if I look at the Companies Act, and particularly for that Companies Act, we were talking about 456, there is a immunity given, 463, but again it was coming up that you will be liable under section 149(12) if it is coming through the board processes. Is it not the board processes? And I will say that I am losing my immunity as an independent director because it is every knowledge which I am approving it, I am giving the justification. Tomorrow any authority, if everything goes fine, nobody will question me. But moment the transaction gets so, I think the independent directors will be the one, they will say, oh, you are the person who has approved it. You will be also caught in the same way. It happened in, I think, I'll not name Mr. Vyasa, where he is saying, independent directors in their case, Supreme Court said, okay, impound their passports also, they will also not to be run over. No, that is the way the authorities look at it. Is it not that, okay, we have to really see and what kind of protection, what kind of safe harbor rules we need to think about and provide. That's the, I think the point which I'm trying to make it. What would be your question before I go to Sanjeev? Sanjeev will say, oh, no, not giving me the time for this thing.
No, but this is basically larger issue or larger point being raised by Satwinder on liability of independent directors, correct?
Yeah.
So first let's step back. The legislature had made very clear that when it comes to RPT, even if you have non-independent directors on the audit committee, only independent directors will vote for it, correct? That's very clear, it's already a law. There's nothing being changed in the disclosure standard right now, correct? The second is when you are making audit committee responsible, they were already responsible to say that only from today the audit committee is going to be responsible to say that it is not going to be prejudice to your company. It is going to be on the same terms of non-related parties. It's bizarre, correct? That is the basis of the definition of related party, is that you are going to give it on terms not less favorable, not otherwise, which you are doing with unrelated party. That's the basis. Now let's come to the basis of the liability of independent director. There is no shying away that the liability will be the same as enshrined in 149(12). That means acts of omissions or commission of the director, non-executive, independent director out of board processes, which either you are doing it in connivance or not acted diligently. The same language will apply over here. That means what are they trying to say is that you are aware of board processes. You are on a notice that you are aware. And what is the awareness coming from? Two things. Actual awareness, that means what agenda you get, presentations you get, the backups you get for all the related party transaction. And the second notice we say is constructive notice. That's more important. Constructive notice is making the right inquiry when a related party transaction comes, correct? So what is the difference between what had happened during Satyam and what's happening today? In Satyam, when the independent directors made a mention that 1000 page document is coming to us at 9 p.m. and next day 9 a.m. we had to decide on metas. They were given the benefit of doubt of being victim and not perpetrators of the fraud. Today, the regulators, judiciary are not that liberal. If you are on the driving seat and if you are going to be told that I am not blinking my eye, I am not to be prosecuted, there is no automatic immunity to tell that you are actually the victim of the fraud. You have to prove it by documentation. You have to prove it that I have raised all the right questions when I was in the driving seat. The process is important. Nobody is saying by doing this independent directors become liable. No way, I am saying. It's a disclosure regime, correct? Because please understand, if there is a related party transaction which goes wrong, it is the beneficiary first who's going to be first hauled up. The KMPs have given you, CEO, CFO have given you certification. I am not saying for a presumption that that is the entire edifice, that is the basis on which you create an edifice, correct? The basis will be from management, from the CEO, CFO, from the promoter, that these are the basis on which it is done. Basis that audit committee in a manner forms an opinion for a related party. So all I am wanting to make a mention, it was already there. To say that the disclosure standard today has made any major change is not a really right way of looking at it. They were always liable, even earlier, because it is only independent directors who can vote for related party transaction and not otherwise. But would love to hear Sanjeev and others.
No, because there are so many, you see, related questions I'll come to, because if I say that can I be absolved just merely as an independent director, I would say on this thing, just merely relying on the certificate which the KMP is giving,
need not.
Or I need to have that independent evaluation. To my mind, which you are saying, if there is no rating, credit rating, audit committee and the independent directors have to look into the credit worthiness. Do I need to engage independently the consultants and other thing to make
Very
it?
good
Because
point.
there are larger questions on that.
Absolutely, absolutely.
Right? So before this, because Sanjeev, I know little bit because I have a long association as regard Maruti is concerned, and there are number of joint ventures, and particularly how the Maruti works is lot many joint, could be about 200, 300, and where you have a 26% equity and this thing, the procurement is coming and all that, and all those entities will be constituted as the related parties because of the work which you are having it is. Two things are important which I need to discuss on that part. One, the material transactions, and you see, I know even in our SSB when we were discussing about it, I still remember that Sanjeev had a different view than which SEBI had taken, and Linde judgment which we were discussing. Aggregation, whether it is a transaction which that opinion had come in the Linde that okay, and the SEBI put it, no, it is a cumulative per company, all transactions over a period for this thing. They said it's an inclusive definition, right? So we debated it in the SSB long time. No, I am no more on that SSB, but still that thing was working on that part. So we had an excellent debate on this thing. What do you think that with this new norms, which standards which have been here, do you think that okay, there is a need to change the materiality? Because the way your transactions are, in any case, the 1,000 crore is like a peanuts for you, and it is coming as a material. The data which you have to collect it, because all the data will form part of the agenda items, right? And if there is an urgency to conduct that related party transaction, how do you seal that what all that granular detailed information which you need to provide it to the audit committee, what are the operational preparedness you feel is required, and whether if it is a laxity? That is the one question. Second question to you is that okay, if I am failing to provide, and that means and it is a prerequisite, Before approving, you have to see. That means I am violating the law. Can I say that it is a void transaction or a voidable transaction, or I will be subject to certain panel but the transaction stands approved? What would be your impact on this thing? Because I'm just talking about the law also on this thing, because then I will say, because it's a law.
Correct.
And if I'm not providing that information and your management says, koi baat nahi yaar, let's move ahead with this thing. How do you feel? How do you prepare yourself? With, I would say that could be the, if you have to go for a related party transaction, it should be not less than, I think, less than 1,000 pages, the information which you have to provide. How do you feel about it?
So thank you, Satwinder ji. The first disclaimer is that, like Narayan Shankar ji
So
said,
two
that
questions
it is
for that. That's so you
fine.
and you can supplement or comment on that.
So the first disclosure is that, as Narayan Shankar ji said, that the views of his is not from the forum. My views are also not from the Maruti itself, and also not against any member of this forum. These are all independent judgments and the what we think as the professionals. See, as far as the materiality is concerned and the Maruti is working is there, I never found the what exactly was the logic of having this 1,000 crore. It started with 10% of the consolidated turnover in the starting, and then there was an exemption for the royalty at the 5%, the limit. And thereafter, then after 5 or 6 years or 7 years, then suddenly this 1,000 crore limit was inserted in that provision, that 10% consolidated turnover 1,000, means the regulator is saying that the largest company as in terms of the turnover is 10,000 crores, because the 10% is the 1,000 crores. When it came in 2021, Satwinder ji, my company's turnover was already 1 lakh crore. So this 1,000 crore was only 1%. So the regulator said, okay, we will take the approval whatever they need. But then there was no clarity in the provisions also, whether we are talking about the class of transactions or we are talking about the sum total of all the transactions taken together, and we have to go to the shareholders for approval. If you see the definition of related party transactions in LODR, it has been taken from the accounting standards. It is the the transfer of resources, liabilities, or whatever is there. It was taken from the accounting standards, and under the accounting standard, this definition means when you disclose these transactions in the balance sheet, you have to disclose all the transactions separately. The sale of goods separately, purchase of capital assets separately, provision of services separately, and so on. And in the LODR, it is also written that all material related party transactions need shareholders approval. Now, in the recent case in Linde India, when the assessing officer of SEBI has taken a view that material RPT means sum total of all the transactions, then what is the need of giving in the LODR that all material related party transactions need approval? There is no all material related party transaction. It is the pecuniary relation between listed entity and its related party. You add all the transactions. If the sum total is more than 1,000 crore, go to the shareholders. Taking an example, suppose I am having 5 transactions of 200 crores each with my related party. Sale of goods, capital assets, services, etc., same related party. It is going to be more than 1,000 crores. So I have to go to the shareholders for approval as per that Linde India judgment, though it is now under appeal.
Yeah.
So that there is no, there is no logic of materiality as such. Now, after 2021 till 2025, has ever a regulator thought about it, that what about the companies who are growing? In 21, my 1,000 crore limit was only 1%. Now my company is 1,50,000 crore in 5 years. That 1,000 crore limit has actually reduced from 1% to 0.67%. Now I am taking the approval of the shareholders for 0.67% of the transactions with my related parties. So that is the one part. I think it is very easy to go again and again that, okay, when something is moving very smoothly. Someday, you constitute a forum and start thinking that, okay, because there are some complaints, as Narayan ji said, that from some independent directors to SEBI that the information is not coming to us, start thinking about the good governed companies, big companies also, be it Maruti or Mahindra and Mahindra or Infosys. What about them? What is their role in that? And then you are giving the responsibilities to all the independent directors. You see, we have not thought about the business. What we are thinking is, whatever the disclosures we are making to the audit committee composed of independent directors, they will definitely approve this transaction. This is a pre-thought. I am going to the audit committee. Now suppose one of the independent directors say that this is not acceptable to me. Whatever is the disclosure, this is the minimum information, but you have not given me the, the details of the bidding. Now in my case, I have 40 joint venture companies which are running since 1990 onwards. Now what was the logic of having, Satwinder ji, that those constitution of JV is because I was not having the technology in India. My promoter went to Japan, went to European countries, etc., requested them that since come to India, make this technology available to India, let us localize them, and but the one condition is you have to have 26% equity in that, so that whatever I will produce, I will give it to you, because Maruti was the only company then. The Hyundai was not there, Tata was not that prevalent, Mahindra was not that prevalent. So let us give my all production to Maruti. I have made 30 joint ventures, they are my related parties. Now under these norms, now what is they are saying is, give the details of all the bidding. So it is not a off the shelf, the civil work. I am not going for a bidding for, I will take the cement from ACC or Ultratech or whatever. This is the technology which is transferred from outside to India. And that is where is the bidding. I don't have the bidding of 3. Then I have to justify to the audit committee that I have not taken the bidding for 3. If the 3 biddings are not there, then audit committee has to justify as per these norms why the biddings are less than 3. And if any bidding is rejected, then the audit committee has to justify why it is rejected. So how is it possible to, the comply these norms as far as the big companies are concerned? So my request to the regulator is that just think about the big companies also. They are good governed companies. When we started the, after the offer for sale, our price was offered at 125 rupees. No related party transaction norms were there. In 2015, it touched 10,000 rupees when related party transaction norms were not there. It is now 13,000 rupees. So even if we have those norms or not, the good governed companies do the business in the best interest of the minority shareholders. That should also be taken into consideration. Now the second point, how to work on this, giving this information to the independent directors of the audit committee. In Maruti, we have already started this. We have constituted a cross-functional team of the company secretary, CFO, then the auditors, and the third party consultant who gives a presentation in every audit committee is from the big 4. So the minimum information of related parties, the transactions, etc., we are already having, so which we have already made. The problem is like, the bidding. Second is the CEO KMP certificate. On what basis CEO will give the certificate? What exactly is the process and systems? Do I take the back-to-back certificate from my supply chain division or the engineering division from which a transaction is being proposed, that okay, you justify that it is in the best interest of the company, only then I can go to CEO to get this certificate. Then if you take the on page number 32 or whatever where the CEO certificate is there, in the next point it is given that we have to justify to the audit committee that this transaction is in the best interest of the minority shareholders. So at one point of time you are taking the CEO certificate. Secondly, you are also justifying in another point that it is in the best interest of the company. Either you take one, either you take the justification or you take the CEO certificate. You can't have the, everything. Third is the royalty. Royalty, what we are now asking for the minimum information is what my promoter is getting in the percentage terms and the amount from all the companies all over the world, the amount of the royalty which they are taking and give it to the audit committee. There are confidential agreements between these parties. My promoter is having an agreement with the Suzuki Thailand, Suzuki Malaysia, Australia, New Zealand, and these agreements are all secret and confidential in nature.
Yeah.
How can I ask my promoter that, okay, you give me the whatever the royalties you are taking from them?
No, I think because the time is short, you talked about royalty and that was the question. Sorry, Neerja sir is saying that, okay, close it. Because when I was making the questions, it was coming out to be for about 45 questions. I reduced it to almost 12, 13, but I was knowing that, okay, we have to in 1 hour close it with the 5, 6 questions and all that. Very important aspect of that royalty, which is there. Now, if I look at the FEMA regime started, it was free, the royalty.
I was
right?
coming to that only.
Then was the transfer pricing norms. They said that, okay, you have to look at, because even on the transfer pricing norms on the royalty. Then came the SEBI regulations and other things, bringing 5% of this thing. Now coming to the royalty again for this thing, I was wondering, when you said that if it is a composite, give the, you see segment wise that how do you feel that, okay, this much is there, whether it is for the brand, it is for the technology, and you have to divide it to that part, number one. Second, even if I go for this thing, but the important aspect is the royalty is my expense. It is going to be P&L. You are asking me dividend paid in last 3 financial years, and if the dividend is less than the royalty, audit committee to comment on the reasons for less dividend.
Audit committee has to comment.
I'm really not looking at it is that how the royalty and the dividend are making it is. Then the another part which is very, very important, which I'm just making it is in said technology. You are asking the company to develop the in-house R&D undertaken so that the royalty can be substituted. You will have that own technology, and if you will provide all these conditions in the contract, nobody is going to give you the technology.
Right.
And then they said if no expenses were incurred for your in-house development, audit committee shall provide justification to comment on the same. No, I am just making it is that, is it that, okay, we are going, I'm just this thing, are we going overboard on that? Notional loss. And all these things are, because the concept is different. When I'm saying that I'm having a transfer pricing regulations, your transfer pricing audit will be done at the year end. You have to do the transactions now, how you will justify it, how you will make it. There are number of issues which can arise for this thing. And when, Narayan, sorry to say, when we are talking about it, I think Savitri has joined, she is also the member of the forum.
Pramod is also there.
Pramod is also there. But I'm just making it is, when it is industry standards, is it that, okay, one standard for all industries? As I said that for companies like Maruti, companies like, we can provide caveats, we can provide exclusions. I'm not against that, the transparency, accountability, protecting the minority interest, but how we have to provide the caveats so that certain industries, good governed already the companies, how we can provide the exclusions. I think to that extent, but again, sir, the last to you, if you can sum up, is it that few instances where certain independent directors are approaching that they are not providing information? Is it the change in the law is the only norm, or we can think about something else? Over to you, sir, for this thing before we wrap up that question.
No, I had not intended to make any observations. I thought the wisdom of the panel is adequate for us. But 2 or 3 things that came up in the discussions, and I will address them. One, I think Neerja summed it up very well. It all stems from a lack of trust. You are not trusting people, therefore you're putting more and more prescriptive arrangements in place. Number 2, what does related party transaction intend to address the restrictions? What it intends to address is conflict of interest. And when the law was framed, there were two requirements. The transaction should be in the ordinary course of business and should be at arm's length. Now, it is what lawyers like you call a rebuttable presumption that there are intelligent people sitting in the audit committee. They should ask whatever questions are required so that they get the answers to these two questions. Is it in the ordinary course of business? Is it an arm's length transaction? Now, I'm amazed that independent directors go to SEBI and tell SEBI we are not getting information. Once upon a time, I used to be the SEBI chairman. If somebody had come to me, I said, if you can't get information from the company on whose board you sit, you give up your job. Don't come and try and fire off my shoulder and say, company is not giving me information. Are you a primary school student? You're crying on the teacher's shoulder. I think you shouldn't be doing that. So directors, I think, should learn to extract information, not go and complain. The second point is, you mentioned royalty, dividends. These two things just don't sit together.
Yes.
Now, there is a related point there, which I'm sure for want of time alone you missed, which is, if you cannot compare with a peer group within India, look for a peer group outside India. If you cannot find a peer group outside India, then you ask the analysts to generate. वो कहाँ से लेके आएगा? I mean, will the analysts conjure up a peer group when you've not been able to find a peer group within or outside India because of the nature of your business? Then the question that you touched on, get an expert valuation done. Valuation is done by people who have expertise in valuation, I imagine. Otherwise, you wouldn't ask them to do it. Then the audit committee comprising non-experts, they're not all valuers, maybe one or two might be by accident, more than by design. They will sit in judgment on that, on the expertise of the expert. Basically, that's what they're sitting in judgment on. We have tied ourselves up in knots. I think we should now go back to basics, use these 3 months to just junk this, rewrite a much simpler sort of set of prescriptions which address this question. Is the audit committee in a position to ensure that there is no conflict of interest? For that, let the audit committee ask whatever questions there are. If you read this minimum information, alongside the 3 communications that have come from NAFRA, giving a tutorial to the audit committee, you must ask the auditors all these questions, right? And if all those questions are asked, your meetings will last 3 days at least, no question about it, if the auditors answer all those questions. Number 2, are you in a sense completely abandoning judgment and just sort of, I will trust this guy, I will get that expert. Why are you sitting on the board? You've been brought to the board because it is believed that you have the ability to think logically. You might not be an expert, but the ability to think logically, to ask the right questions, to seek additional information. And there are people on the audit committee with expertise. Lean on them to get more light shed on this. I personally think that we are barking up the wrong tree. The one question that you asked up front, which I think remained addressed, does any other jurisdiction have anything like this? Short answer, I think, is no.
No. That's it. With this, I think I must acknowledge and thanks to the panelists for taking out time and making it, and thanks to sir for giving us
questions. Yeah.
We may overshoot a little bit. I hope you don't mind the slightly delayed ones. Then it's okay. We can take. Press the switch on the left side, you get a green light.
Thank you very much. I think a very good discussion. My name is Alok Goel. I represent from Motherson. My short question in the interest of time will be, are we looking for audit committee purposes, independent director role to be some time of an executive role for a running RPT? Are we looking for that? I think the question answers and kind of a responsibility which they have to ask each question on this aspect is may become an executive role. Specifically on bidder, I think very well said that it's a proprietary kind of a product. In case of auto component, I am with you that maybe each of the product cannot be rebuilt in a year of times, right? It takes 3-4 years at times to be built up. If we are looking for a product or a 3 months deferment, maybe again after 3 months that proprietary is not there, and it's not the lowest code which you are looking for. Maybe you are looking for a continuity of a product much larger period, and the interest that the IP or the intellectual part is not been kind of a stolen and being used by your competitor, maybe Hyundai, Tata or anyone else. So that's very difficult to achieve. I think even if we make 10 cross-functional team in our processes, we won't be able to achieve. The earlier was job work. We may have some markup of that, which was much more prevalent. That depends upon the intellectual part or the proprietary nature of information. You do a markup of 5 to 7% or to 10% or a 15%. I think that discretion should be for the management. Otherwise, we are looking for, again, independent directors running the business. So that's my one point, and I'll come back on our related party definition per se. I think when one thing happens, let's say Satyam happens, we all are now obligated to file annual encumbrance certificate. So maybe all 6,000 companies are doing. However, that's been observed maybe in 5 or 10 companies. Similarly, if we look for promoter related party definition per se, I think the point been taken, whether the promoter are interested or not, but in a case where there are joint ventures, listed entities subscribing to the equity vis-a-vis a third party who's not at all relevant. So the comprehensive disclosure to that aspect should be kind of a thought of, because it's not ultimately individual promoter or let's say Suzuki in this case is interested in that related party, because wholly owned subsidiary been exempted, but the subsidiary part, even if you have a 3% of an individual earlier promoter with whom you have sold, and it's an independent third party, it's a related party, and you end up having everything. However, the ultimate promoter of your listed company is not a party. So it's very different. I'm with you. Okay, you enhance a disclosure requirement, but are we kind of doing again a tariff within India? I'm not sure. So thanks.
Just a quick point. The audit committee assumed an executive role in 2013.
Yeah.
So that is when support when the other people were doing things right became the decision maker with nobody to figure out whether.
So then we should actually look for an independent
No,
actor.
I'll
Are they
just-
actually independent?
I just have a slightly different view here. It's not that the audit committee is playing, sorry, you've raised many questions. I'll try to see what I remember because it went a little bit long. First is whether audit committee is playing an executive role. Answer is definitely no. Okay. Like Mr. Damodaran said, in 2013, based on cases which happened, it was need of the hour. And need, I'm specifying NEED. The earlier concept was NED, non-executive directors. What was the need of the hour in 2013? Let non-executive directors be more engaged. And hence we have got a concept today, non-executive engaged directors. And that was need actually of the hour in 2013. So you need to be engaged when you're in the driving seat, correct? Number one. Number two, you made a mention about bidding. Sanjeev made a mention about bidding. Just want to clarify, bidding, 3 bids, all just a mechanism. It only applies if it is with a promoter entity. It is not applying for other disclosures. Second, like you rightly said, we'll give you multiple examples. You gave me one. There is one power purchase agreement. You have a subsidiary exclusively giving power because you want to be assured it's a power intensive industry. There the question is, doesn't arise. It's a disclosure regime and it's a template you'll have to follow to say the business model doesn't envisage a third party, and that's the explanation you have to give. So all what we are probably the regulator is trying, comply or explain. At least explain that you're not able to give for what. Second, you mentioned about automotive companies. Yes, you will have subsidiaries being formed exclusively for supplying engines. It can never be, it's high art of the facility engines which is going to be provided, and you need that engine for the next 5 years. There's no question of having bids over there, correct? From multiple people, etc. Third point, I think we mentioned about dividend vis-a-vis royalty. The whole thing is coming right from the earlier regulation we've discussed multiple times. Dividend goes to all shareholders vis-a-vis royalty going to the majority shareholders. That's the difference they are trying to say is in a manner, see how do we put it? When earlier there is a requirement today even in ICDR, dividend cannot be paid in lieu of bonus, for example. So hence what are you telling? Once you have paid bonus, the next year please for heaven's sake don't skip a dividend because you cannot do. Similarly, the question raised is if you are paying loyalty and you are going to skip dividend, that's not a great way of doing business, correct? That's certainly not. So I'm just giving you another what I'm saying when we are peeling the onion, other view aspect of many of the things. But certainly what I'm just saying, it's not executive, you'll have to be more engaged, you'll have to ask all the relevant questions.
Yeah.
Sure.
One point regarding this royalty and dividend, because there was a study by
Absolutely.
SEBI,
Yeah.
However, how much the expense in India we made on R&D, it is only around 0.7% of the total GDP. I think the root of that, increasing the rather than making royalty as a, the problematic thing, let us come with another law like CSR activities that, okay, the companies have to spend, 1% or something on the R&D activities. I think that would be rather good route rather than making the differentiation or the, the relation where there is no rationale between the royalty which is actually booked in the profit and loss and the dividend which is paid out of the profits. And I think that there is no
Sanjeev,
comparison.
I think the point which
the gentleman is already standing, sir.
Be a light-hearted observation. You
Sorry.
said in 2013 directors became more engaged. Now you've married us.
So sweet. Oh my God. Yeah, sorry. He was standing from quite a long time.
Yeah, one point I just wanted to make.
The mic, please. Mic.
Not only is the audit committee probably
if you can
getting
give the
executive.
introduction to all, I think.
So, yeah. So I'm Venkat. I work for JMR Group. Yeah. So good
Very
afternoon, gentlemen.
Go ahead,
Yes.
Venkat, please.
So the point, not only is the audit committee getting executive, I think we are looking at the non-executive promoters also now becoming executive. I'm unable to visualize, we file something like each of our listed companies file about 700 to 800 RPT line items every half year to SEBI, right? Yeah. Maybe even if half of them are repeat RPTs, at least 300 RPTs is something that we generate every half year. So I can't imagine calling the promoter every day or going to his house every day, explaining the RPTs, transactions, picking his mind. I mean, this is something I'm unable to even visualize. Is that required? Is a promoter required to get engaged into a company to that level? That too without threshold limits. There are no thresholds even for promoter certification. Is that something? I hope that it can be revisited. And I hope the name can be changed to maximum information rather than minimum information. But I'm not able to think of anything else beyond what is already there.
That's only a minimum information.
So that's what, sir, I'm not able to visualize anything beyond that. What else can be given to the audit committee?
See, if there was Pushpa, there will be Pushpa part 2, correct? So if you give maximum, how will we be able to come with the next round of? Sorry, I ran a item. But on the second point, Venkat, which you mentioned, I think it's a very important point. Promoters who are non-executive and being asked, that point has come to, I think is under active. Lot of people have raised it. And one recommendation which has come is, can promoters be asked to certify only those transactions where they're interested and not encompass all transactions? Specifically where the promoter is not an MD or not in the working management. Because if he was MD, it would automatically come from bottom up as part of the CEO, CFO certification, correct? This point is very valid, Venkat.
With some threshold. I mean, there are transactions even 100 rupee transaction going to.
I think this is the right time, like Mr. Damodaran said, there is the new leadership is ready to listen to many of the things which has happened in the RPT regime. So please give your comments, it will really help.
I tell you one thing, on this RPT, my MD actually asked a question to me. Sanjeev, our RPT is bad because in Japan, we do the business with the people to whom we know. We actually develop them, we develop our vendors, etc. But why in India, we don't trust them? And I had no answer to that, because it is because of the legislation only, it is not from the business point of view. And he was asking me from the business point of view. Then he again asked that India and Japan entered into a comprehensive economic partnership agreement. And there are many clauses, around 60 clauses are there, on the basis of which the Japan actually started investing in India on thousands of crores. And one of the clauses is that the whatever is the regime is there as far as the legislations etc. are concerned, they will be in favor of your investment. This is the agreement between India and Japan. So by indirectly doing all these legislative changes, are we complying the provisions of that SEPA or not? That is also we have to see. It's a slightly bigger question, but I think the legislators don't see into the agreement between the countries also. I think that should also be taken into consideration.
Sanjeev, just to your point, what you said is the basic logic in everywhere. Monopoly is not bad, but abuse of monopoly is bad, correct? Similarly, related party transaction is never meant to be bad. What you say, abuse of RPT is always a question from the regulator side, and hence, how do you address that abuse is what? But how can we have a balance between business and this? Of course,
so that
they are
is
all
Shankar, the
struggling with the balance, correct?
But Shankar, the information overload that we are expecting all of us to comply with, and the already overburdened KMPs and audit committees, no way our RPT is going to go through, easily, because half the time information will not be available. The audit committee members are not going to put their signature on something which is incomplete information. And also, did any one of us envisage how many hours of effort is going to go behind just collecting all this information, and more importantly, is it even contributing in a constructive way to the decision? So the point I made earlier, we have a very robust framework, right? I think we've all been doing very well in being conscious keepers of our respective organizations, and in making sure that we get the right data, we ask the right questions, and we present the right papers to our stakeholders. So somewhere, I think there's going to be I hope to God that there is some serious rethink about what is it that we are asking all of us to collectively comply with.
So Neerja, if I have to answer on a because she has got God in between, so let me just answer it in a philosophical manner. You have Neerja, law of karmic accounts. What does the law of karmic accounts say? If you have a good, you will get a good. If you have a bad, you will get a bad. You cannot offset good and bad in law of karmic accounts. But in corporate India, how it happens, one bad corporate conduct will lead to one bad law. Yeah. And when one bad corporate conduct leads to one bad law, that karmic account applies to the industry as a whole. That means even if I have not done, I still have to be part of the industry and follow. So I'm just saying that's the only thing on a philosophical note I can end. Yeah. Thank you.
Joe, thank you so much.
Thank you everyone for
all. I
listening.
think.
Thank you, panelists, for the insightful discussion on an important topic. May I now request Mr. Damodaran to please present a memento to each panelist. We have time for a cup of tea and coffee, and we shall then move to the next session. In the interest of time, I request you to please take a break for 5 minutes. Our second session is on facilitating decision making by the board. Let me introduce our panelists. Ms. Savitri Parekh is the Company Secretary and Compliance Officer of Reliance Industries. She is the Chairperson of the Governance Committee of Bombay Chambers of Commerce and Industry. She has been a member of the working group to review provisions relating to trading plans under the SEBI PET Regulation 2015. She has published 4 books. Mr. Pramod Kumar Rai is the Company Secretary and Compliance Officer of Nestle India Limited. He is a non-executive director on some subsidiary boards of Nestle, Corporate Law Committee of FICCI, National Committee on Regulatory Affairs of CII, and a member of several committees of ICSI. The third panelist is Mr. Damodran. May I now request Mr. Damodran to welcome our speakers.
It's very light, it's not heavy. Sometimes they give you very heavy stuff.
Thank you. Oh, okay. That's really very light.
And it doesn't need water.
Wonderful.
It's a self-watering. Yeah.
Okay. Nice jade plant.
Welcome back. Hope you've managed to pick up a cup of tea, coffee, whatever is on offer. Right. Some people still are outside. I'm hoping they will troop in the course of the next few minutes, but we are already behind schedule. I thought that we had some agreement from all of you that we could overshoot and have a somewhat later lunch. It won't get too late, I assure you. One, of course, is that we have one panelist less than last time, so per capita time might be also a little less. So let me make a few introductory comments. Firstly, I must thank Savitri for this subject, the topic of today's discussion. I was chatting with her when we were thinking of putting this program together, and I said, can you suggest some topics? She said, this is one you should do, which is broad spectrum. It covers everything that company secretaries do because they are a part of the board, and how do they handhold boards, how do they help boards to take decisions. So that is what we are going to address today. Now, I have been, if I may take 2 or 3 minutes, I have been on several boards for several years. I stepped out of all but one of them a couple of years ago, maybe 2 of them, maybe less than a year ago. I'm only on one board now. But I have gained insights into the functioning of the board or the non-functioning of the board over the last several years. Some boards have been non-functional also. I take great pride in saying I've written to people that my boardroom experience is that I have been a part of good boards, been a part of bad boards, been a chair of good boards, been a chair of bad boards, been on public sector boards, private sector boards, and all manner of boards. I've seen all of them up close personal. And that is why this is a very fascinating subject. The board, I need not tell people like you, all of you definitely know this far better than I do, that the board is central to the way a company conducts its business. It does not conduct business. I explain in great detail to people when I do programs for them that it is managements that run companies, boards don't run companies. Boards ensure that managements do their job well, but they don't roll up their sleeves, they don't run companies. And yet the board is critical because the shareholders, other stakeholders look to the board to ensure that their interests are addressed. That especially in companies where, because of the decades of distrust of promoters, people feel you need someone to look at what is happening a little closely and act as a kind of a countervailing power in the boardroom. Therefore, the board is critical. But I have seen directors on boards, I told you the kinds of boards that I've been on, some of whom are exceptional. They come prepared, they ask the right questions, they speak only when they have to speak, and contribute consciously, in very constructive fashion, to decision making by the board. At the other end of the spectrum, I have seen directors who come unprepared, who in the olden days, before we started moving into technology, would not even open the documents that were sent to them as pre-reads for the board meetings. They wouldn't open it. Occasionally, they would thumb through those during the board meetings while the discussions were on. So I've seen directors at both ends of the spectrum. Right. Now, you have directors who have domain expertise, which according to me is a double-edged sword. If I come into a board with domain expertise, and especially if I have been a previous CEO, and I've heard this said, I'm not thinking this up, I've heard this said, jab main CEO tha. Now, jab main CEO tha is dangerous for a board. There is another CEO in position. Let him or her, having received the baton, run. You don't second guess, you don't step on the toes of that person, because once upon a time you were a CEO. And especially the immediate predecessor CEO graduating to the board position, it's a very, very bad practice, and one that we in our consulting engagements recommend strongly against. If we find somebody who is moved to the board after having been an executive, immediately we say that there's a danger here unless the person knows what to do. The other problem that you have in boards, and I divide directors into two categories, there are those who have something to say. Equally, there are people who have to say something. Not that they know the subject, but because they're in boardrooms, they think they must express a point of view, is often uninformed, it is often completely irrelevant, diversionary, unproductive. But they also make interventions. And we believe that if somebody is appointed the chair of a board, he or she hits the ground running. The minute you're appointed, you think that this person has what it takes to lead the board. And I have found that is simply not true. There are chairs who get lost in the process of chairing boards because they are not prepared for the responsibility of chairing a board, not being told by someone what you need to do, what you don't need to do. So therefore, there is a free-for-all in the boardrooms, which is not good for decision making. Now, in this kind of a background, the one person who is flying the flag of good processes, good practices, good governance, conduct of business in a proper manner is the company secretary. It's not the easiest of jobs. If I were to rewind and go back, one of the jobs that I would not have accepted if it was offered to me was a company secretary's job. Because keeping is bad enough for a school teacher, keeping young students disciplined and attentive in a classroom. Think of the company secretary having to keep directors, all of you do it, I'm carrying coal to Newcastle to tell you this, keeping old people, many of whom are past their sell-by date and should be sitting at home watching Netflix or Amazon, but they are in boardrooms, thinking that they are contributing to the running of the company. And our studies in the company have shown us that there are a lot of boards which are value destroying, some boards which are value neutral, and a few which are value positive, which add value to the board. Now, that is the situation in which all of you operate. But you belong to the better off companies, both of you. You might not have seen that kind of directors that some others might be privileged. I'm using privileged in a very, within quotes, privileged to see on boards where you're wondering, why did this guy come in there? Was the door kept open and he just strayed in there and just saw a chair vacant and sat down? Is that the kind of director you have on boards? So these are issues that have to be grappled with. Now, in this background, I'm going to ask both of you, and we will spend a little time with the audience, given the kind of experience that resides in this audience. What do you do as a company secretary to ensure that boards deliver on what they are tasked to do? Let me start with you.
Sure. Thank you very much, Mr. Damodaran. Of course, this is a very interesting topic, and I am privy to the discussion where we had this discussion and we decided on this.
Yes.
And as you rightly said, it's the company secretary who can bring forth an intelligent discussion on a proposal. Of course, very often what happens is the company secretary is not the person who is the creator of the material. So therefore, getting the material from the different departments and they give you a portion of it, you're not capable of adding value to the basic point which has been brought out. However, a company secretary can certainly raise the questions. It's more like the first point where the company secretary raises the questions which the directors may probably raise. Having said that, how do you facilitate decision making by the board? Today, in fact, we've come to a stage where independent directors not only do a due diligence on the companies, but do a due diligence on the company secretary who is going to be the secretary to the board. Because the kind of papers which would be placed before the board is going to pass through the company secretary. Very often the presentations may be very technical, but there's, it's okay to be just going through it and raise 3 more questions more from an innocent perspective, and you realize that you've shaken the apple pie cart sufficiently for people to go back to the drawing board and make the presentation more meaningful. This does happen. For example, even with respect to audit committee, where there is an information overload, as was being mentioned by Neerja, it's quite possible to ask them to prioritize, have a RAG report, red, amber, green classification, and tell them that only the red ones are going to be discussed by the audit committee, and green is just for information. Amber is more like raising questions, if at all there are, where the audit committee raises questions, if they want any specific responses from the team. But otherwise, ensure that the operating team is present to answer all the questions which are marked red, whether it's an operational efficiency or otherwise. So long as it's the internal audit team answering the questions, you're never going to be actually able to see change. Change is change in behavior of the persons handling a particular issue, and not change which is discussed in the boardroom. Boardroom discussions, discussing of change is like having a blueprint which can never get implemented unless the persons who are supposed to implement are very much there. Talking of decision making, while under section 180 and as well as few other sections of Companies Act, there's a very clear reference to what the explanatory statement should cover. The statement accompanying notice should cover. But when it comes to board meetings, it's left to each individual company as to how you want your governance standards to be developed. What would be given, how it would be given. Like say for example, make or buy, different scenarios being painted, a portion of it coming in the presentation but the rest of it going as pre-read. Of course, now secretarial standards read with Companies Act mandate circulation of the papers at least 7 days before the meeting, which is much better than having a situation where there's nothing written out. Now, just having a provision which says notes need to be given, you could have a half-page note or a 3-page note with a half-page executive summary. What should be chosen as the desired model, I would say, is left to the company secretary. Have clear order in which points would be taken up at the meeting. The ones which require maximum discussion, place them first, because they are the ones where people are going to be actively discussing, debating, because by the time you come to the end, and if noting items are placed towards the end, or if it's placed towards the beginning, let it be ones which only come up for discussion if any of the directors has an observation. Otherwise, given the regulatory framework today, there are several items which come up for noting. Just to quote an example, Schedule 2, Part A, LODR, gives you a laundry list of items which need to be placed. If you take a discussion and not just for noting and by exception, you're going to be spending a lot of time. The board is here not to only note items, but to add value to decision making, which was also mentioned a little while ago by Mr. Damodaran. So I think the way in which the agenda is structured, the way in which papers are circulated beforehand plays a very important role. Needless to mention, we were talking about minimum and maximum information just in the previous session. I think it's not about quantum of information, but the quality of information and how exactly it is presented. Don't keep everything for just presentation at the meeting, because the information overload and a very short time span would not enable very good discussions. Let me pause over here, because we could take on more questions after Pramod gives us.
I have a
Sure.
supplementary question for you before we go to him.
Sure.
Who sets the agenda for the board? Because decision making ultimately is the product of discussions. Discussions are the product of an agenda.
Absolutely.
Who sets the agenda for the board?
So, in fact, on this, I have a very simple take. Ensure the terms of reference are drawn not meeting to meeting, but well before. And terms of reference, of course, in case of listed companies, you do have LODR, based on which you would have the initial term, basic terms of reference, but don't stop just over there. Good governance is not about only compliance. It has to be compliance plus plus. Look at business needs and dovetail that into your terms of reference of the committees. For that matter, you don't have anything for the board per se. However, you do have precedents. You do have practices which the company would have evolved over a period of time. And prepare your calendar of items for the whole year at the beginning of the year, if not 3 months before the end of the previous financial year. In which case, you at least know as to what you're going to be covering, what are the contents of each of those items. Ensure that the concerned stakeholders are socialized and they made the process owners get the items. What happens then is, if there is anything which is added on, which will only be a statutory addition based on business needs. In this manner, you would clearly have 4 buckets: routine items for noting, non-routine items for noting, routine items for approval, non-routine items for approval. And the second set, the third and the fourth, non-routine items for approval and routine items for approval, you need to have clear time allocation so that at least minimum that much time is spent on those items. For example, routine items for approval would mean the quarterly financial results, auditors' observations. All these, you do know they are fairly textbook items, and you anyways would have your precedents. You know the kind of time allocation you need to have. Typically, we do not plan with respect to time allocation. That's exactly what's required to be done, whether it's the audit committee meeting or the board meeting. Don't just push too many items. If you feel it's going to take more time, take the item out, push it to a special meeting. In any case, most large companies today hold 10 to 12 audit committee meetings in a year. Have a special meeting where you're going to be discussing items like contingent liability, what is the principle that you're using, and what needs to be put in, what need not be. So just to answer in one sentence, the framework has to be decided by the company, and the company secretary plays a very major role in this.
Okay. So turning to you, tell me, we often hear this business about, and we heard it this morning, adequate information is not coming to the directors. Is that a complaint you hear in your company, or are you hearing from your colleagues that directors are not getting adequate information, therefore they are not in a position to decide? And again, you hear the opposite. Too much is being given to us. They're mixing up data and information. In my book, information is actionable data. There's a whole lot that's not actionable, which you can ignore. But is the board then being swamped? Because I know in 1 or 2 companies where there was complaint that we are not being given enough, the company secretary decided to respond as he knew best. He flooded them with so much information, so much data, that they said, why are you giving us all of this? So the truth is somewhere in between. You can't get too little, you can't get too much. Is information flow a problem with boards?
Thank you, first of all.
Not just your company,
yeah.
you'll have to.
Yeah.
As I said, you know, in these conferences, what happens, we get good people here.
Yeah.
The people that should be attending this are outside. So we get the people here who actually know
how to conduct business.
No, that's very tricky challenge for each company secretary, let me tell you, with regard to the adequacy of information to be placed before the board. And also committees. What happens is, as far as rule book is concerned, we have SEBI listing regulations, we have Companies Act, we have secretarial standards, we have guidance notes, we have FAQs. So there is whole lot of document which is already provided, which fix some of the items for quarterly agenda items, whether it is results or important items that has to be taken up. But the challenge for us is always what else in terms of adequacy. And when some agenda is fixed, we decide on not just adequacy, but also whether the information is worth taking any decision by the board of directors. It's not something which is just a presentation. Like if a presentation is being sent by the business owner, we run through the presentation. Unfortunately, that's the 30 part we have to do it. And we tell them that please tell us why you have put this presentation, why this slide is there. To me, it is not relevant for the board. Then they say, because I have to present it, I need some context, so I am putting it in the presentation. I said, look into it again. Sometimes the presentations runs into 80 pages, 90 pages. The time given is 25 minutes in the board meeting. And actually, that 25 minutes is already not there. If, as you rightly said, if some director leaving his phone asks a random question, it takes another 15 minutes. Or if somebody has already read the presentation, there will be questions. And there will be time constraint always in every board meeting. So we, as far as adequacy is concerned, we ask them, if you are given 30 minutes, you have to present this. If you have given 15 minutes, this is what the crux of the presentation you have to give, which will help the board to decide. So this is the way, at least for the time being, we are managing. But adequacy is a very difficult task for each company secretary. Sometimes even the agenda, we fill so much of information, so much of sections, then we start re-looking at it, whether there is at all a need to quote that section, quote that relevant provision, or does it really need to be something which director needs to know, or is it helping the director to take a decision? So these are very difficult questions to answer, but at the same time, it is a best judgment that we apply. And the best part is have a meeting with chairman of or chairperson of either committee or the board at least 7 days in advance. Tell them that this is the agenda item which we are going to run through the meeting, whether it is committee or board. Let them decide how many items they want to take up. As Savitri madam said, there are many legal requirements to present agenda items. What we do is we also go back to see what performance evaluation of directors is. What are their expectations as a board when the flow of information is expected? Or what is the outcome of an independent directors meeting? What is their expectation? Some of the items, agenda items we pick up and we put it in the annual calendar and we try to accommodate that. Second point is on not just adequacy but accuracy also.
Accuracy, timeliness.
Timeliness is something which is talked about. Directors do complain that they do not get the information on time. 7 days is too much for any presentation to be made to the board of directors. What we try to do is ensure that it is at least 48 hours before the meeting. At least crux of the presentation is presented to the chairperson at least 6 or 7 days in advance. You get the expectation right, and you start, as Savitri madam said, you would prioritize the agenda items, agenda for discussion and decision, agenda for noting. So now after COVID, because generally sometimes company secretaries run the meeting, they read the agenda items and then the discussion starts. It happens. But a small note for each agenda item specifying that these are the legal requirements to the chairperson really helps, I am telling you. Now they ask for that yellow paper, like we highlight those portions and give it to the chairperson. They said, where is my yellow paper 2 days before? Because that gives a clear guidance. So as company secretaries, our job is to ensure that they are well facilitated to take a decision. I would stop there. And as you rightly said, the agenda is not for the board of directors or for the committees. It is with the committees or the board.
That is right. That's what I was leading to.
Yes.
Anyway. Yeah.
And the quality of input is what the quality of output is. how we present the data to the directors is the quality of decision making that they will be giving.
Absolutely.
With that, I conclude.
So in your experience, have you seen over time, there are too many presentations being made, and I'm following up on what you said about presentations and you send it out 48 hours in advance. Some people don't do that, and I'll come to that in a minute. So are boards becoming what I call prisoners of PowerPoint presentations? That the presentations take up too much time, and therefore based on the presentations there's not enough discussion taking place. It is that the management presents something, it is very colorfully done, very attractive, so they become prisoners of that, and then either they endorse, most of the time endorse whatever is said. There is no meaningful discussion taking place. I have one more question following up, but after I'll leave with this for you. Yeah.
Yes, it does impact the decision making when you have colorful presentations running along
Yes.
for 1 hour, 2 hours. So it's us to ask that question to the business owner or the presenter. What is the outcome? What customer wants? What the board wants? What is the decision that is expected from the board? If we continuously ask that question to the business owner, slowly, over a period of time, we have reached to a stage where presentations become secondary, and there is out of 30 minutes, 10 minutes is for presentation, 20 minutes is for discussion. So it has over a period of time evolved, especially during COVID times when we are all sitting in before the screen. It was very difficult to manage those meetings, but it has brought at the same time a lot of discipline in the way we present the information to the board.
No, as our surveys which are in your bag show, attendance went up during COVID meetings because you could sit in your house and attend.
Yeah.
You were not required to take the trouble of traveling, and suddenly board attendance went up. It shot to near 100%. But staying with presentations itself, I have seen after the secretarial standards came, some people became very smart. Now you have to send this out 7 days in advance. So what do you send out? So the agenda pack that you send 7 days in advance, that date is respected. But you say first you have the minutes of the previous meeting for noting. Maybe some companies have the action taken report after that. Then you have a number of important business items, all of which has a one-line agenda note which says a presentation will be made at the board meeting. Now, how am I as a director expected to come prepared if my first sight is in the board meeting when I'm seeing the presentation? I have to see it, absorb it, formulate questions, ask questions, and that will overshoot the time that you have. So is there some discipline that should be brought into that kind of board packs not being sent? We push back all the time. When we look at during our assignments also, and when I was a board member, I say, look, ask yourself, could this not have been sent earlier? Why are you presenting it at the board meeting? This is not UPSI, right? This is information you had. Then why take the lazy person's option of saying the presentation will be made at the board meeting? Send it out. Let me read it and absorb it first. That is one question that I have for you. The second, and both of you can take this, looking at the time available for meetings and the fact that some are routine items, compliance, you have a long laundry list. 98% of that has been done. You've sent this out a few days earlier to the board. So there shouldn't be any discussion on that. The other two where action is still being taken or where the nature of action is such that some directors have a question, you should do that. Can we slowly get to a situation of exception reporting? Either of you can take this. Yeah.
Sure.
Yeah, so I can give an example of exception reporting in terms of reporting compliances. Like for example, if we start presenting all the compliances to the directors, it would be a very boring presentation first of all.
But you expected to, no? That entire list.
Yeah, so what we do is, there is a dashboard.
Yes.
We, instead of putting a whole sort of reports to the directors, we say you please go through this deck, which is a deck which has all the concerns reported, all the compliances reported, and ask them if you have, these are the high, low, medium risk compliances which were which were monitored in last quarter, and this is what it is. And we go by the exception. They decide what to see, and we then go into what are the corrective action plans against each, and then presenting the scenarios, and not us. For example, if there is a business case where there is a concern reported at a factory, I do not present. I am only one of the mediators as a company secretary. I request them to give half an hour. I request the director technical to come and present to the board the nuances of what happened and how the corrective action plan has been taken. So it's a very simple, we take little time, we ask them for a half an hour, we take 5 minutes and explain that. So that's how compliances are managed. But presentations, again, coming back to the difficulty, generally business managers, as we file tax returns on the last day, it all happens on the last days. All presentations are made in the last days. So what we have done, if presentations are not coming within 48 hours, even we are able to review it, we drop that agenda item with the permission of the chairperson. It has brought a lot of discipline in.
You know, one of the pieces of advice that I give to directors is, if a presentation has 4 or more colors in it, be careful. So a trap is being set to attract you. If anything has more than 2 colors, be careful about what is being presented. You're being taken up the garden path. But on exception reporting?
Sure. So exception reporting, of course, is something which most large companies use, especially with respect to items for noting. However, with respect to compliance, you cannot just leave it saying you're moving up the exceptions, because in the director's responsibility statement, the directors are giving a certificate saying that there are systems in place for ensuring compliances, and these systems are working efficiently. So just as a backup, what I would suggest is ensure that the process that is used by the company to map compliances, to identify compliances, and the process of monitoring compliances is presented to the audit committee at least once a year, if not once in 2 years. You know, this would be a good practice, because there's an assurance with respect to the process, and on a meeting-to-meeting basis, you just you know, escalate issues where there are concerns, because anything to do with compliance also has a reputational issue attached to it.
Yes.
Therefore, it's very essential. Just, of course, the top sheet could just be a one-pager giving a confirmation that there are no exceptions, if there are no exceptions, and the detailed dashboard could form part of annexure. So one is the board agenda, and then you have the board notes, and then you have the supporting papers.
Yes.
If these supportings are made from a list of data, as one would call it, have that as an annexure where the directors can access, just in case they want to validate 1 or 2 points. That's the way the hierarchy of the papers should be.
So have your directors ever told you that the responsibilities on them arising out of provisions of the Companies Act, LODR, whatever, are far too onerous and they can't handle it and they need your help? I will give you one example. Directors are supposed to certify that the right accounting policies are being followed. Many directors, even if they want to know, don't know where to find the accounting policies, because they've never applied their mind to it, and yet they certify. They're certifying all manner of things in the director's report. Has somebody come and told you, look, I am signing off on all of this, but I am doing it just in good faith?
Yes, it do happens, and this is a very often a question at the board meetings and the committee meetings. Am I supposed to do this? Is this my responsibility? For example, I'll give a small example. Internal auditors of typically MNCs and other companies not only just look into the financial statements, frauds and other areas, they also look into reputational aspect. For example, manufacturing operations. They are also, they are not just chartered accountants or management accountants, they are also from operations team. When it is presented to the audit committee that these are the operational issues that were arising in the factories, they ask a question whether I need to know this, whether this is part of my domain, should I look into these?
Do they push back because they're worried about responsibilities?
Yes,
okay.
they do sometimes push back on many of the matters. But at the same time, we say he is an internal auditor, he will not filter the information based on whether it is financial or whatever are the concerns, they will place it before the audit committee for their consideration. If it is required to be minuted and a corrective action plan has to be taken, whether it is operational or a financial issue.
Moving to another subject, information asymmetry. Now, there is information asymmetry, we know it, between the whole-time directors and the non-whole-time. My bigger worry is, and that is because somebody is an insider, somebody is an outsider, there will be a difference.
Absolutely.
But within the community of independent directors, those that are on the audit committee, for example, get far more information than those who are outside the audit committee. Is that a constraint in the boardroom, and how does that get addressed? I know the chair of the committee makes a presentation to the board, but is that adequate, or is there any other? Is that a problem at all?
I don't think that's a problem, provided you have sufficient number of meetings of independent directors where the chair of the respective committee briefs the other directors about the issues, the major issues which have been discussed at the meetings.
At the IDs meeting.
At the IDs meeting. And also they share their experiences in terms of chairing those respective meetings. Let's say, for example, if I were to look at the audit committee meeting, which is a, now of course you have the audit committee, NRC, as well as the risk management committee. All three are very important.
Yes.
And there's lots that each of these chairpersons can share with the other directors, assuming there are three different persons who are chairing the three committees.
Yes.
So even the manner in which a topic is discussed, like say for example, risk management committee has a very close correlation with audit committee.
Yes.
And therefore there could be a lot of items which one would get to know from the other committees, which then gets shared. Additionally, at a board meeting also, the chair of the respective committee, there are matters where they speak and give their views, which is also an assurance to the other board members. Is it necessary for all the independent directors to have the same level of information? Answer is no. All these committees are basically giving an assurance to the board, and it is for the efficient functioning of the board. Having said that, there may be certain matters where the board may decide, or the independent directors may ask that the information should be just given to them with respect to, it could be with respect to related party transactions, it could be with respect to contingent liabilities, or whatever the company decides. These could be given to all of them. In any case, the minutes do go to all the directors, but the minutes would never capture everything.
It won't capture.
One of the points which you raised a little while ago about accounting standards and accounting policies. Typically at the audit committee meeting, one of the questions which is necessarily asked by the chair of the audit committee to the auditors is one of change in accounting policy or the treatment given by the company. Like, for example, it could be with respect to depreciation or the useful life of an asset or otherwise. Now, this I would say should also get minuted, not in terms of the useful life or otherwise, but at least in terms of no change in the accounting policy and practices and accounting standards have been followed uniformly. For example, a small thing like provision for bad debts. If you have changed the practice, it could have an impact. The fact that the company has not changed, such a question being asked, it is always good to minute it. Prior to 2013 Companies Act, minutes were not looked at. Of course, it was always a very important document, but it was not as elaborate as it is now. Of course, even today, it's not necessary to write, he said so, she said so.
He said, she said is not required.
Yes, that's not required. However, the gist of some of this discussion, because God forbid if there is some reason for any of the regulators to take a look at your minutes, the minutes should speak. At least the major points that were discussed should clearly come out, so that application of mind by the directors concerned is very clearly brought out in the minutes.
In fact, it's interesting that you say what the minutes should contain, because we tell people it cannot be a record of decisions alone, right? It cannot be at the other end, every word that is said in the boardroom gets captured.
Absolutely.
So we actually tell people that interact with us, you must capture the flavor of the discussions. And predictably they ask, what do you mean by flavor of the discussions? So no better than FMCG company to answer what is the flavor of the discussions?
No, so as
Yeah.
Savitri Madam rightly said, when we are recording the discussions, all the important discussions are to be summarized in one way or the other without naming who asked this question and who answered this
That is my next question, but
Yeah.
continue. Yeah.
So,
yeah.
so an insider, when they reads the minute, will be able to make out what the discussion is completely in terms of who asked the question, when this question was asked, what was the outcome. But when an outsider or a regulator reads it, they should be able to find comfort that these points were discussed, not more than that. Because there are different ways of looking at the minutes, inside view and outside view. We have to balance it out in a way which does not expose the company or which does not expose the directors. Just to answer one of the questions that you asked with regard to how the committees also contribute to the board discussion or how the directors are involved in information sharing. Typically what can be done is we all have digitization now. So we ensure that the committee agendas are also having access to all the directors. All the independent directors have, whether they are part of the committee or not,
That's right.
they are
yes,
having
yes.
access to the board agendas or the committee agendas. Number two, they are also, because the sequencing of the events are not like there are no two concurrent meetings. So if a director wants to attend, we always send the optional invite. They come to the meetings.
Right,
Most of the time, therefore, board meetings run not more than 3 to 4 hours, but committees run more than 4 or 5 hours. So that's another way of doing that. So supplementing that, yeah.
Right. Now my related question arising from what you said, we've discussed the minutes, right? Independent directors meetings you referred to. Now the Companies Act provision in Schedule 4 is hugely inadequate because it talks in terms of at least one meeting, and in India certainly, I don't know other jurisdictions, but if you say at least, only that will get done. Only that minimum will get done, and that is ostensibly to go through the process of a board evaluation. I have several other thoughts on that particular provision. I won't trouble you with them. But a meeting of IDs before every board meeting, is that a practice you think adds value? And if so, should it be made mandatory by the regulator?
So I don't think it's essential to have a meeting of the independent directors before every board meeting. However, if there are important items, it definitely would be good to have a meeting. Let's say, for example, if it's only the 4 statutory board meetings where you are supposed to be considering the financial results, maybe
no, when I say every, if you have 10, obviously cannot be 10.
Absolutely,
but
yeah.
Certainly 4 or 6.
But certainly more than one. I mean, of course, even LODR now has made it recommendatory, of course, to have at least 2 meetings of
this is the problem.
directors.
We are in incrementalism. We're moving from 1 to 2. Yeah.
But at the same time, the independent directors informally also talk to each other. But having said that, if I were to look at it as a formal meeting of the independent directors, 2 meetings is fairly good. Less than 2, I would say, is not really a good practice.
Okay.
Before every meeting, probably it's not necessary.
Before every quarterly meeting?
Before every quarterly meeting, I would say it's not essential.
Okay.
Before, maybe the half yearly and before the year end, certainly is
What
a
are
good
your
practice.
thoughts on that?
So the meetings do happen, like informal meetings as well as
there's
of
informal,
independent directors,
unstructured, no agenda.
Unstructured meetings.
Yeah.
Generally, it happens after the board meetings.
Okay.
For an
yours
hour,
is
they
after.
review, like for example, one of the things that came out during independent directors meeting is exposure to second line of leadership.
Yes.
So that comes out after the board meeting. They realize that the second line of succession is not being presented to the board. So we minute it in that way. All the suggestions which they give, it is formally written to the chairperson of the company, and then it is incorporated in the minutes as well. But there are a lot of insights through independent directors meeting, the flow of information, the kind of agenda items that need to be taken. For example, nowadays in independent directors meeting, there was an emphasis on having a presentation twice in a year on cybersecurity.
Oh yeah.
Okay.
So that came from, we had a mandatory requirement under law and we used to do it, but it is coming out very strongly from them. What are you doing about it? On succession planning, on talent management, because companies are what people are. So these topics, they are independent directors are discussing independently and then recommending to the management. That is something which is I think very positive outcome for the independent directors meeting. And I think it should be the board to decide, or the lead independent directors to decide whether to conduct 1 meeting or 2 meetings or 3 meetings. It should.
One even SEBI has decided is inadequate, but they are not going full throttle and prescribing more.
But the scope of the meetings, today if independent directors asked what we will do in the separate meeting of independent directors, we don't have much to say except performance evaluation of board, executive directors, chairperson, and smooth flow of information to the directors. But now they have themselves increased the scope of the independent directors meeting to an extent that it can really bring changes in the way the board conducts meetings.
Do you think committee memberships, there should be rotation? Or somebody gets appointed, let's say, to a committee, serves out 2 5-year terms on that committee. Some other people are out for their entire 10 years, but they are in some other committees. Should there be rotation?
I think it's person specific, I would say.
Okay.
As a general statement, I don't think it is essential to have rotation, because to some extent with respect to committees, you know, while as a board member, domain expertise becomes a challenge to a large extent, as you also mentioned in the opening remarks. But as a committee member, for example, with respect to audit committee, you would always want somebody who understands the financial statements, while someone else may be pretty good with respect to human resources. So you use that person, because you also can bring in international practices and as well as, you know, benchmarking and whatever is happening, or for example, cybersecurity. Incidentally, cybersecurity is something which most risk management committees go through it at every meeting and not specifically be bound by what SEBI has stated. So coming back to rotation, it again is specific to persons. Having other members attend the meetings is something which is always encouraged and is a good practice.
What about you?
It's an evolution. We don't think so. We have targeted or focused discussion around the rotation of members of the committee. Okay. But I must say this is now coming up with the rotation of auditors, secretarial auditors. This is also coming up. And I'm sure this discussion will be there in the boardroom going forward. But yes, this was never thought of that audit committee chairman could be could be rotated after 3 years or 4 years. It was not envisaged earlier. So this discussion will start.
That is because you had one chartered accountant who would invariably be chairing the audit committee, and even the law is inadequate. Yes. It talks about only that person having expertise. So in fact, there was a recent case, I'm sure all of you have seen that, where a distinguished retired member of the armed forces was put on the audit committee. Some things went wrong, and when SEBI took his evidence, he said, look, I was never told that I needed to understand this. I was invited to be on this committee, I came, but I certainly don't understand what is happening here, and you can't hold me responsible. So you have that kind of membership also on the committees, which is not such a good thing. Any other area before I throw it open to the audience that you want to specifically mention?
So one of the specific points that I would like to mention is with respect to meeting with the credit rating agencies, which happens at least once a year. And this is a very, very good meeting where you get to know as to how engaged your directors are, because this is a meeting where they speak to the credit rating agencies directly. And that's exactly the one where, you know, the kind of information that is placed before the board comes to the fore at these meetings, because it's they who are questioned and they are the ones who answer and not the management. So the test lies in their ability being able to handle this. And second and most important one is, you know, it's not just the meetings. You can always talk to the directors, take feedback from them, understand their perspective with respect to changes that they want to see, not just in terms of meetings of independent directors and their suggestions, but what each individual director has, his comments or her comments, so that you can build it in and take it forward. It could be, and I've often found it to be very, very useful, because there are a lot of small issues which come up when you speak to them. And last but not the least, the regulatory scenario is changing pretty fast. Rather than spending time at the meeting, maybe giving a small summarized statement on a monthly basis also builds in trust that you're at least aware and you're taking care of the requirements. That's what is more important. Nobody wants to make the directors into lawyers.
Any
I think
issues that you want to address specifically?
it's not issues,
Yeah.
I must say. It is more to do with the evolution of board evaluation has completely changed over since the law came and since SEBI listing regulations also specify. It has started maturing, I see.
I
Like-
know. When we started out doing board evaluations 10, 11 years ago, the kind of resistance,
Yes.
why do we need to be evaluated? We've been invited to come on the board because we're good people. Why does our goodness have to be verified on an annual basis, etc., etc.? So I think from there we made some progress. I won't say we are entirely
Yeah,
there.
so like board decided to have a separate meeting for performance evaluation, dedicated 1.5 hour for only discussing on performance evaluation of the board, committees, individual directors. It has brought in a lot of focus, like third party involvement, rather than just doing it on a questionnaire basis. Lot of qualitative aspects have started coming, although otherwise it was all quantitative. Meeting attend kiya, nahi kiya, how many meetings attended.
0 to 5 scale, everybody's rated 6.
Yes.
Yeah.
Directors were little apprehensive in giving the feedback for other directors, but the way the regulatory changes are coming, the responsibilities of board is increasing. Now there is a critical evaluation of other board members as well. That is the change that we have seen. The second part which we have seen is lot of talk about the CEO's appointments, the transition plan. Whether it is promoters' right to nominate a CEO on the company or not, independent directors wants to have a say. Even before it is announced, it is shortlisted, they want to get involved, they want to bring on the table whether that CEO is worth running the company or not is a question that they ask now.
Okay.
Which is two changes which I wanted to
We'll
specify.
take a few questions from the audience. I recognize we are 11 minutes past 1 o'clock. If 1:30 lunch is okay with all of you, we'll get started. Yes. Keep the questions brief so that they get enough time to respond.
My small question is, yes, as far as submission of the IMA is concerned, 7 days is enough, except for UPSI items. Normally, executive management runs against time for submission of, say, annual accounts agenda till last moment. And the kind of onerous responsibility has been cast on the audit committee. They want as early as possible. So how much time is adequate time to serve the information or to feed the information to the audit committee chairperson at least, one. And second, when law recognizes that there is a potential leak, and therefore they say that least time is to be given between the audit committee and the board meeting. So it becomes more important that how much time is adequate time. Savitri ma'am.
Sure. So actually it's very important to have a round of discussion with the chair of the audit committee as well as the independent directors and explain your perspective as to why you would like to give a very short time window with respect to UPSI matters. But what is also important is if you're giving them short time window, points based on which they're going to be discussing and giving their inputs needs to be put on one slide with maybe not more than 5-6 sentences, so that they are able to look at this and come up with their points. If this is done, I think the directors will be okay to get information in the last minute with respect to UPSI, with everything else coming to them well before time, so that all other matters, they won't take much time to discuss and devote maybe 1 hour to only the financial results, which are placed before them only in the last minute, which is fine. And in any case, the secretarial standards require you to take consent
Yes.
on a yearly basis. So when they do that, they're fully aware as to what they are getting, when they are getting. There are divergent practices in the market today. Few companies give it 2 days beforehand. Few others give it 7 days before time. Very few companies, I would say. So the question is not of when you should give, but what is it that your directors are comfortable with, and how are you ensuring that this does not in any way compromise on their independent judgment, although you're giving them less time.
Just following up on what you said, your problem is they're saying we don't get enough time.
Right, sir.
But you mentioned there are some that send it days in advance.
Yeah.
I know of companies where the directors have said you keep it with you, don't send it so many days in advance, because they're worried about leakage. They might not contribute to the leakage, but if leakage happens, everybody's documents get looked at, your telephones, everything then gets looked at. So you have to see. The ideal situation is have the audit committee meeting on Friday evening after markets close and have the board meeting on Monday morning. So nothing will happen in between, and the board will get enough time to study the papers. Any other questions? Yes,
Thank you.
please. Yeah.
Just a point probably on the independent directors meeting. I mean, I think more than the
Mike,
numbers,
Mike, yeah.
more than the numbers, I think what's important is something should come up on follow-up action on independent directors meetings decisions. Because I think the general perception that independent directors carry is, okay, we've given our feedback, but then what happened to that? I mean, generally they don't see action happening on their whatever submissions they've given to the chairperson. Maybe if something can come up on a specific item on follow-up actions on independent directors meeting, that might help, one point. Second, I think, sir, regarding overall facilitation, a view is that, or my experience, maybe I would want Savitri, especially if you can vouch it, is that pre-board discussion and engagement with the directors, especially the non-promoter directors, not in a cluster, but a one-on-one meeting where you take them through the agenda. I think my experience has been that is what helped in facilitating smooth board process and board decisions. Where I mean, it's a way of, even if they have anything on mind, they tell you, either you clarify or then you get back to them. Rather than sometimes there's a feeling that board meetings are rushed, so a conversation beforehand, not only at the board meeting times, even before also, so it develops that, not about familiarity breeding contempt, but about gaining trust of directors. I think that was one. And third point, sir, last, is on the non-board members. I think there's often been a complaint by the non-board members, especially those who are not on the audit committee and on the risk committee, that they're not adequately informed. Committee meetings happen very elaborate, but board meetings are rushed through is a general, again, a misnomer or maybe a fact also.
But that was answered. Said invite them. Those that are complaining, invite them.
Invite them, or
Yeah.
maybe brief them separately, yeah. So
No, I think the question really is, first question that he asked, feedback to the independent directors that your valuable suggestions have been considered, this is what we've done. How do you ensure that?
So that is actually ensured, because whatever feedback you get from the independent directors, action items are prepared and they are kept informed, and they actually see the actions being implemented.
But that's not a uniform practice, I think.
It's not a uniform practice.
It must be in your company maybe, but not a uniform practice.
Yeah, it's not a uniform practice, but that's absolutely essential. Otherwise, your trust that you've built with the directors is going to get eroded.
That's true.
That's
they
something
go
which you
through
need
the
to
motions of discussing,
Right.
and after that you find that nothing comes out of
Nothing
it.
comes out.
How do you do this?
Yeah, that's same.
Yeah.
Yeah.
The feedback, it's us as a company secretary, because what happens is the points, summarized points, go to the chairperson of the company. They come to us for minuting and then ensuring that it is translated into action in coming year. So as part of the annual action plan, what are the immediate actions which we can take out of the feedback?
But is that a normal practice? Because the independent directors are to meet in the absence of management. So one of them actually keeps a record and shares it with the chairman.
Chairperson.
With the chairman.
So it is in the bulleted form, like 10 or 8 points which are
action
being
points
discussed.
come to you from the chairman. Okay.
It is forwarded to us that these are the points that are minuted, as well as action plan is made for the entire year as a
I
annual
think
action.
Venkat's point was, does that get communicated to the directors that, look, we're taking you guys seriously, what you've suggested, we have acted upon them. Yeah.
Yes. Yes. So as part of the board meeting, after the board meeting, the independent directors meet. So independent directors, the points, the action points, the feedback given by the independent directors is recorded after the board minutes, and summarized way is signed by the chairperson, because it's the chairperson who is receiving the comments from the independent directors, lead independent director. So if he is, how otherwise it will translate into a feedback and corrective action?
Before taking the next question, the gentleman had his hands up. I want to do an audience poll. In how many of your companies is the IDs meeting before the board meeting, and how many is after the board meeting? How many are before? Before. Okay, now let me see after. That's the impression I had, that before would, how do I answer? Go ahead.
I'm Sharik Malik, sir. I'm Company Secretary and Chief Compliance Officer of Hackery India. We are an asset reconstruction company which acquires NPAs from banks and FIs. So, as you mentioned in your opening remark that the regulators have become, hyperactive these days, and we are a very highly regulated industry into financial services. We've been seeing that, apart from that, sir, the board at board level, sir, which are professionally managed boards and who are not backed by the promoters. There are very high-profile people sitting on the board, coming from various, either from IAS, IPSs, or from.
Oh, that's no answer. I'm a former IAS officer. I can tell you that that's no guarantee of performance.
No, I'm not coming to the performance, sir. I'm telling you the amount of egos which are there at the board level, and the role of the company secretary has become very critical in the sense that how they have to deal with different set of people who have different views about the particular agenda item. This is a question, sir, and ma'am, I have an approach also towards it, that how we basically tackle that situation. I believe personally that the company secretary's role should be very critical in the sense that she must have develop a trust with the board members independently, and the board must have that trust within the company secretary that he is not just representing the interest of the management. And once that trust is developed within with the company secretary, I think he is in a better position to get the decisions done by the board. So this is my approach. Is trust cannot be developed in one single day. It needs to be, it has to be seen through that whether, what is your ethical behavior? Am I supposed to, only take care of the management interest only, or there are several other factors also which needs to be considered. I think this is the approach which we take. I want to hear your view also.
No, by definition, the company secretary is a secretary of the board, not the management. He's a key functionary of management, but it's a secretary of the board. So clearly the responsibility is to the board. I think the question is, how do you manage the fragile egos of directors in the board?
It has to be massaged.
You're walking on eggshells in some companies.
No. So frankly, it's all about how much communication you have. Just before the board meeting, or you continuously have, you find ways to communicate with them. If there is a development with regard to, for example, new standards, how you communicate in pockets, not necessarily through emails, but through WhatsApp. Pick up the phone, talk to them. See, it's all your comfort and trust that is gained over a period of time. There is no cookbook or there is no recipe for it, frankly speaking. There are a lot of ingredients to it which could be used, but there is no recipe or cookbook.
You're right, but ego is not with the company secretary actually. Ego is with the management or with the peers who are sitting on the board.
Ego is what they bring to the boardroom, is your view. It doesn't matter on whom it plays out, but which is why in traditional literature on governance in England, it used to be said that don't pack your boardroom with flower vase directors, those who bring color to the boardroom based on their past thing. In fact, we have advised boards that you go by the warning of the mutual fund industry. Past performance is no guarantee of future returns. Past performance may be in some other play field. That's not going to help in the boardroom. So it's also a question then going back to the mother question, which is how do you get the right directors on the board? But I think
So,
limit
just to
ourselves.
answer your question,
Yeah.
I think it's a very simple test. So long as the directors call up the company secretary to ask for anything, good, bad news or otherwise, everything is okay. Query the company secretary, because the trust factor is kept intact.
Correct.
If it's someone else through whom you get the information and someone else who tells you as to what the director had asked, you have something to work on.
We can take one more question. Oh, there are 3 hands up. I've been a backbencher always. Go ahead. Yeah. Please get the mic to him. Yeah.
Thank you, sir, for giving me the opportunity. I'm Shiven Suman, Company Secretary of Hero FinCorp Limited. That's basically a company promoted by Hero Motorcorp. So hearing all the speakers and sorry, your kind of advice and suggestions, I think it's not that tricky. The one thing which came in the end, like confidence level which director reposes into the company secretary, in case that's being taken care of, I think everything is settled. I have personally experienced that. We had been having many meeting, like we are talking of 2 or 3 independent directors meeting prior to the board meeting, etc. I think, sir, regulator has already mandated those kind of meetings with the audit committee, with risk management committee, etc. Like you need to have a meeting of CCO, Chief Compliance Officer, prior to the...
That's because your regulator is the Reserve Bank of India.
Yeah, but sir, that was also a problem. Like we are having a company secretary also acting as a Chief Compliance Officer. As per the NHB, National Housing Bank, that's not warranted for. There is segregation between the Chief Compliance Officer as well as company secretary. So maybe the regulator is thinking it from a different perspective altogether. But in case we are able to repose that kind of, gain that kind of confidence from the board members, that prior to the meeting, we are having a meeting of Chief Compliance Officer with the audit committee or with the audit chair, with a meeting of the CRO with the risk committee, similarly meeting of the internal audit head with the audit committee chair as well as audit committee. I think that gives many confidence to the committee members, including independent directors. So if that's being maintained, probably things can be dealt with in a quite comfortable manner.
Let me shift to the front bench.
Thank you, sir.
You had a question.
Yeah, I had a very small question, in fact, an open-ended one. But there is a lot of shareholder activism, and I use a little broader term in terms of public activism as well, right? And the common issues are compensations, ESG, right, CSR, and ethics, things like that. The softer issue of governance, right? And my question, and there are also now proxy advisor firms, right, who give opinion on the quality of your decisions also, right? So what do you think, or do you think these guys are your company secretaries' friends or foes? And how much do you rely on them for your decision making at the board level?
A short answer, and I'll pass it on to. See, frankly, so far as you are able to take a decision which has a justification, rationale, you are able to disclose what you are supposed to disclose, you are ensuring that the confidentiality is maintained. Proxy advisors will ask for everything. They will ask for the moon. It is up to the company to ensure that while the decisions are taken, the interest of minority shareholders, or to say so, public shareholders, are protected. Obviously, there are occasions, if you are looking into investor relations, you come across a lot of institutional investors who come and want to speak to the management. You should facilitate that discussion with the management. So far as it is not some consultant coming from outside and want to set up a FMCG business, for example, and getting all the information from the company. That should not be encouraged. But as far as performance of the company is concerned, so far as anything which is in public domain is concerned, something which is a clarification, we definitely engage with the institutional investors and proxy advisors. But relying too much is something which we have to draw a balance.
You can't outsource judgment.
Yes.
Come, yours.
Sure. So proxy advisory firms are mandated to place their policies on the website, on their website. So it's a good practice to assimilate and collate the policies of all these proxy advisory firms and be prepared. It's basically in terms of disclosure or in terms of their voting mandate as to how exactly they do it. It's not just the proxy advisory firms, you also have the large institutional investors, the pension funds and the rest, who also have their guidelines, and most of them today focus more on ESG. And of course, now the focus on ESG in US as well as in Europe has gone down slightly in the recent past. But that's not the reason as to why you should or should not focus on ESG. But having said that, with respect to say on pay or a few other matters, it's more from a disclosure perspective where they come down heavily. Like for example, in Companies Act, you have 5% remuneration being given to one director, 5% of net profits, is something which all of us were used to under section 197. But if you have a resolution which provides for 5%, you're definitely going to get a negative recommendation, because they want the absolute amount to be also specified. So how exactly is the absolute amount going to be worked out? Can the basis be specified in the explanatory statement? Are issues which you need to certainly consider, because having one negative recommendation means the institutions which are now mandated to compulsorily vote would certainly go by the recommendation of one of these. And the first proxy advisory report which comes out is like the leakage of the final leakage of the results of a candidate who's waiting for the examination results to be out. You're never going to be very happy seeing even one negative recommendation, in which case you need to look at it proactively and ensure your explanatory statement has the necessary disclosures. Institutional investors, yes, of course, I certainly second what Pramod mentioned. What's also important is the large institutional investors, you can actually see their voting trend. Their questions that they ask are more or less in sync. And today when you talk in terms of ESG, it is net zero, which all of them see, and the methodology that is adopted by the company. The energy conservation report, which was always done by the manufacturing team, is now read thoroughly, not only by the ESG team, but also by the secretarial team. Because this is one from which people do come up. Go ahead.
It was not about shareholder meeting.
Sure.
It was quality of decision making at the board level.
Right.
So does those...
So, yeah, I'm coming to that. Yes.
Quality of decision making.
It does to a large extent, I would say, because voting results, after the voting results are analyzed, you would be anyways giving a report to the SRC committee at least, if not to the whole board.
But don't you think the damage has been done by that time? Say, for example, you are putting up a compensation at the general meeting and it gets stuck down and you are going back. The damage has been done.
So that is completely unacceptable. So you would be ensuring that there is no damage by proactively working, by ensuring that, see, when would this particular disaster strike? If you have not taken care of the proxy advisories policies, if you've taken care of it, it will never go wrong. And you will also have your own precedents, and also look at the recent past, both Indian as well as international ones. Because today it's not just the proxy advisories in India, but the ones overseas also which have a major say. And also you'll need to be very, very acutely aware of your shareholding pattern. What exactly is the mix? Is it domestic institutional investors or the foreign ones? If it is FIIs, you would definitely know as to which ones they are actually going by and guided by. And you will have to ensure that those are taken care of. So prevent the damage rather than handling the damage control.
So as a board practice, do you present their views as well when these critical decisions happen?
It's not given to the whole board, because the whole board is not going to be interested. The executive directors, yes. Stakeholders relationship committee, yes. And the board note which goes out initially, we do this analysis. It does not actually get covered, because that's something which is not required to be covered as a note in the agenda. But is this taken cognizance of by the team? 100% yes.
Thank you. In the interest of time, I think we will stop the questions now, because otherwise lunch will get further delayed. Yeah.
Thank you, panelists, for a very observing session. May I now request Mr. Damodaran to please present a memento to each panelist. Thank you, ladies and gentlemen, for being with us. We are now at the concluding part of the program. May I request Mr. Damodaran to make the concluding remarks?
I'll keep it absolutely short. I think we've had two very interesting sessions. Time, of course, is a major villain in such matters. It prevents us from having as detailed a discussion as we would like to have. And the questions that certainly exist in your mind but have not been asked can be the subject of mail exchanges. We don't want that they remain unaddressed. You can send us mails. We will divert them to the panelists. I'll request you at this stage to recognize both my fellow panelists by applauding them for what they have done. I had a ringside seat, so I also gained some knowledge in the process, right? What we will do, we are a governance company, as I mentioned up front. We will certainly keep track of everything that was discussed here. We will remain in touch with all of you, whether through our newsletters or other communications, see what we can get from you by way of your experience so that the message of governance, good practices, is communicated to a larger set of people who are in the corporate ecosystem, right? All our services are in the brochures that you have. Please read them, see what is it that interests you, interests your company, and we are happy to provide whatever you need by way of strengthening the systems in the company. Let me end with one observation, which all of you have also noticed. You're all worried. The company secretaries have very onerous responsibility. It is getting worse. As my friend said, we have to, among other things, manage the egos of people in the boardroom, etc., etc. The challenges are many, the challenges are varied. But take heart from one thing. When you go to an AGM, the first set of speakers start by complimenting the company secretary. I have found it in all the AGMs that I've attended that several speakers start by naming the company secretary, complimenting him or her, etc. And I can tell you that sitting there on the dais along with the directors, I've heard some of them say, we also did some work here. These guys are walking away. So you are the repositories of trust, and at the AGMs that is expressed by the ultimate bosses who are the stakeholders, who are the shareholders of the company. Rest content with that and see that their cause is served as you're continuing to serve. Thank you very much. We've had food for thought till now. Now let's migrate for some food. Yeah. Thank you very much. Thank you so much.
Thank you so much. It is a real pleasure.
Not